Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Market Risk, a guide for smart investors. Strategies to manage market risk. Market risk can feel like a roller coaster. Managing it effectively requires a thoughtful approach. Here's how investors can tackle this challenge head-on, using some tried and true methods to keep their portfolios sturdy. Diversification. Diversification is like spreading your bets across various tables to minimize the loss if one doesn't pay out. The core idea is to allocate investments across different asset classes to reduce the impact of a market downturn in any single sector. Stocks and bonds. By investing in both, you balance potential high returns from stocks with the stability of bonds. Stocks can soar, but they can also dive, while bonds often offer more predictable returns. Geographical spread. Going global can protect against regional risks. If one economy stumbles, others might be thriving, which cushions the overall impact on your investments. Sector variety. Companies in different industries respond differently to market changes. A tech stock might dip if innovation slows, but consumer staples may hold steady because people always need essentials. Diversification doesn't promise gains or prevent losses, but it does reduce the risk of catastrophic loss. It's like having a safety net under your high-wire financial acts. Hedging techniques. Hedging involves using financial instruments to offset potential losses. It's like taking out insurance on your investments. Options. Options give you the right, but not the obligation, to buy or sell assets at a set price. Call options can help you lock in gains, while put options can protect against losses. Futures contracts. Futures are agreements to buy or sell an asset at a predetermined price at a specific future date. These can guard against price swings. For example, an airline might use futures to lock in fuel costs, shielding itself from oil price spikes. Swaps. Swaps involve exchanging cash flows or assets. Interest rate swaps, for instance, can help manage exposure to variable interest rates, offering more financial predictability. Completing a portfolio with these tools doesn't completely erase market risk but does buffer against volatility. It's as if you're putting on protective gear to shield against market turbulence. Diversification and hedging are two powerful tools in the investor's toolkit, allowing for risk management while remaining poised for growth opportunities. Understanding and implementing these strategies can significantly enhance your investment approach, inviting you to navigate market risks with greater confidence and insight. The role of regulations in market risk management. In the world of investing, regulations are like referees in a sports game. They ensure everyone plays by the rules. They help keep the financial system stable and reduce systemic risks that can lead to market meltdowns. Regulations like Basel III and Dodd-Frank play a vital role in how market risk is managed. Let's explore how these regulations impact investors and financial institutions. Basel III. Strengthening financial stability. Basel III is a global framework designed to promote more resilient banks and protect the global economy from financial shocks. Think of it as a strong, protective wall for banks against potential crises. Here's how it matters. Capital requirements. Banks must hold a certain amount of capital to cover potential losses. This acts like a financial cushion, ensuring they can absorb shocks without collapsing. Liquidity ratios. These ratios ensure banks have enough liquid assets to cover short-term obligations. It's like having cash on hand to deal with unexpected expenses, ensuring banks can meet withdrawals and other immediate demands. Stress testing. Banks are required to regularly test their financial resilience against hypothetical adverse scenarios. This is akin to a fire drill, preparing them for potential economic downturns. These measures aim to reduce market risk by preventing banks from taking on excessive leverage and risk, ultimately protecting both the banks and their clients. Dodd-Frank Act. Reforming financial practices. The Dodd-Frank Wall Street Reform and Consumer Protection Act, introduced after the 2008 financial crisis, aims to promote transparency and reduce market risks within the United States. Consider it a way to keep the financial jungle in check. Here's what it does. Volcker Rule. This rule prohibits banks from making certain speculative investments that don't benefit their customers. It's like telling players to focus on the team, not just individual glory. Derivatives regulation. Dodd-Frank increases oversight of the derivatives market, requiring trades to be cleared through exchanges or central clearinghouses. This reduces the risk of hidden financial Frankenstein monsters lurking off balance sheet. Consumer protection. The Act established the Consumer Financial Protection Bureau, CFPB, to prevent predatory lending practices. It's like having a watchdog ensuring fair play for consumers. Both Basel III and Dodd-Frank have reshaped the risk management landscape, encouraging more prudent risk-taking and increased transparency. These regulations provide a framework for financial institutions to operate more securely, helping mitigate the potential impacts of market risk on the broader economy. When regulations are strong, they help create a safer environment for investment activities. Understanding these rules not only prepares you for what could come next but also guides you in making informed decisions, knowing the playing field is as fair and stable as possible. Case studies on market risk. Market risk, a constant in the financial world, has showcased its might in several high-profile events. These cases offer critical insights for investors looking to understand how external factors can shake markets and alter investment decisions. 2008 financial crisis. Analyze the market risk factors that led to the crisis. The 2008 financial crisis remains a textbook example of market risk unrestrained. What caused it? Several factors collided like a perfect storm. Central to this was the housing bubble. It burst, sending shockwaves through the global economy. Mortgage-backed securities, MBS, seemed safe at first but were built on risky subprime loans. Once housing prices fell, these securities imploded, leaving financial institutions holding toxic assets. This wasn't simply bad luck. Banks underestimated the risk, fueled by overconfidence and inadequate risk management practices. Moreover, credit default swaps, financial bets on debt defaults, added gasoline to the fire. As defaults rose, companies like AIG couldn't cover the avalanche of claims due to these swaps. They were like a chain with weak links, collapsing under pressure. So why did this matter to the average investor? For many, it meant watching portfolio values plummet as market confidence evaporated. Stock markets tanked, and retirement savings took a nosedive. The crisis was a wake-up call, emphasizing the need for transparency and tighter regulation to curb systemic risk. COVID-19 market volatility. Discuss how the pandemic impacted market risk and investor behavior. The COVID-19 pandemic caught the world off guard, and its effect on market risk was both swift and severe. As countries locked down, economic activity ground to a halt. This dramatically affected market dynamics and investor behavior. Initially, uncertainty was rampant. Investors scrambled like players in a chaotic sports match, with stock markets experiencing wild swings. Companies faced unexpected challenges with disrupted supply chains and fluctuating consumer demand. This created a volatile environment where even seasoned investors felt uneasy. A key observation during the pandemic was the shift in investor behavior. Many turned to technology-driven sectors, anticipating long-term growth as businesses and consumers became more reliant on digital solutions. Others opted for defensive investments, like gold and government bonds, seeking shelter from the storm. The pandemic also accelerated the adoption of ESG, environmental, social, governance, considerations in investment decisions. Investors began to recognize that companies prioritizing sustainability and ethical governance were better equipped to weather such crises. For individual investors, this period highlighted the importance of adaptability. Diversification became crucial, acting like a buoy in turbulent waters. Understanding both market shifts and evolving consumer trends was vital for maintaining stable investments. In these case studies, the lessons are clear. Both events demonstrated the power of market risk to transform financial landscapes and the importance of informed, agile investment strategies. They also reinforced the need for vigilance, preparation, and a balanced approach to investing in uncertain times. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.